Hello, in this video, I'm going to share with you the 5 things you need to consider when you're preparing to exit from your business. For the best advice in unlocking a better future for yourself and the people around you, please subscribe to my channel to be notified of a new video each week. So people that have followed the advice I'm about to share with you have not only successfully exited their business, but now lead a more fulfilled life. It's often said that nothing in life is certain apart from death and taxes. Well, if you're a business owner, you can also add to that you will exit from your business at some stage. Might not be soon, might just be at some undetermined date, long in the future. You might not want to exit, or you might choose to exit. But as I said, the one thing that you can be certain of is that you will exit at some stage. So what's important is that you take the time now to think about how you're going to exit. And when I talk about exit or exit planning, what I really mean is about putting the arrangements in place that will allow you to exit from your business smoothly and for the business to transition to its next owners without any hitches. It really is that simple. Too often, not enough thought is given to the various factors that you need to think about. There's no thought given to exit planning at all, or very often, if there is planning, it doesn't actually address all the outcomes that are desired. So it's very important that when you do think about it, you're thinking about your personal goals, your financial goals, and the business goals. And all of those have got to be brought together. They can't be thought of as in their own silos. So there's 2 questions to ask. The first of those is, are you personally ready to exit your business? And the second is your business ready for you to exit? Now we're going to deal with the first of those today, and we'll deal with the second in a separate video. So what I want to do is go through 5 steps that will help you answer that first question to determine whether you are personally ready to exit your business. So the first step is to understand why it is that you're exiting your business. And the important thing is to establish whether there's a balance between the pull factors, the things that are attracting you to your next venture, whether that's a new job, a new business, or simply retirement, and to understand the push factors, what it is that's making you want to leave the business. The happiest of those exits are those where there are strong pull factors. So the first step then is to make a list of the push factors, those things that are wanting you to leave the business, and to list out all the things that are drawing you towards your next venture, the things that you want to do. So the second step is to understand the exits that are available to you. There's probably a video in its own right to go through them all in detail, but broadly you can think of them as falling into 4 categories. One is to pass it on. The second is to step back from the day-to-day operations but stay involved at a much higher level. The third is to sell it. And the fourth is simply to wind the business up. So the action here is to understand what it is that you want to do, how much involvement you want to have with the business, and to consider the things that are going to have a bearing on that decision. That's your family, perhaps the staff, perhaps suppliers, all the stakeholders involved with it at the present. The third step is to figure out what your number is. Ultimately, the market will decide what your business is worth, though it's worth getting a valuation regularly to understand what that figure might be. However, the other part of it is to understand what you need, what your figure is, what do you need out of the business. You might simply be wanting to diversify your wealth, take some out of the business and reallocate it. You might simply want to sell up, get out. And if that's the case, then you need to know how much you're going to need to fund your retirement. Or if you're bored, fed up with the business, you might simply want to get out and recoup your assets, recoup the investment you've put into the business. So you need to understand, as I say, how much you need from the business. So 2 actions here then. First is to get regular evaluations, understand what the market thinks your business might be worth. And the second is to really understand how much you need, what you want out of the business. The fourth step is to decide what role you're going to have in the business going forward. It's very rare for an exit to be a clean break. More often than not, there'll be some ongoing involvement. And the greater that involvement, the greater the potential for bigger returns. But at its simplest, you might simply be acting as a lender, and the buyer will buy your business using the money that comes from their future earnings. So effectively, you're providing that as a loan. One of the other common forms of involvement is what's termed an earn-out, and there'll be some money paid at the time of the sale, but the balance will be paid as you continue with your involvement in the company and achieve certain targets. Now, that can work very well, but it's something to think about. It's very common. It's common in particularly in service industries, and that earn-out might take anything up to 7 years. 3 years, for example, is very common. And what you're doing there is agreeing a set of targets to meet. If you meet those targets, you'll be paid out effectively a bonus. But the thing to bear in mind all the way through that is that you're not going to have the same level of control that you used to have when you owned the company outright. Alternatively, you might be able to agree a simpler arrangement whereby you become a consultant to the business, set of series of previously agreed targets, and you set out and just deliver them, and you're paid a predetermined fee for that. The final form of involvement is that of a shareholder that's actively involved still. Very often, if you sell to private equity, for example, you'll find that although you've sold a stake in the company, you're kept on to lead it. And it gives you a second bite of the cherry. Get that growth that comes with the private equity input, and it allows you, as that company grows, as the business grows, to get a share of the increase in value that comes later. So it can be highly lucrative, but it's also very, very risky. If you don't get that growth, then your remaining shareholding may actually diminish in value, if not disappear altogether. So for the fourth step, the action there is simply to consider the roles that you're prepared to undertake when you do exit the business. So the fifth and final stage is to balance your need for funds with your desire to stay involved with the company. So a successful exit actually means understanding and coming to terms with that relationship between proceeds and involvement. At one end of the spectrum, that might simply be a fire sale. Just get out as quick as you can. It might be a strategic sale, or at the other end of the spectrum, it could be a case of staying involved with a bit of an income coming along with that ongoing involvement. So final set of actions then is to get comfortable with that desired route. But also remember, as you go through this process, your plans will evolve, circumstances will change. And for that reason, you need to keep going back and revisiting all 5 of these steps. So if you're considering exiting your business, there's a questionnaire, or a link to a questionnaire in the description below that will help you ensure that you can leave your company with no regrets. If you've enjoyed this video, please like, comment, share and subscribe to ensure that you're notified of the next weekly video.